Investing through geopolitical conflicts. Hi, I'm John Severs with BCA Private Wealth.
And I'm Jonathan Burns. Chances are you're aware that we're in the midst of a geopolitical conflict that is dominating media headlines at the moment. Our goal today is to share with you how markets have reacted during and after geopolitical events and why investors' desire to do something is most often the wrong reaction.
Here we start by looking at returns of the S&P 500 at the start of some very notable geopolitical conflicts dating back to around the 1960s. And this is not an extensive list by any means, and each event took place during a differing macroeconomic backdrop. For example, in 2022, when Russia invaded Ukraine, the initial sell-off as measured by the gold bar on the left of this chart and the subsequent 6 to 12-month returns were also influenced by a period of rapid rising interest rates, inflation, meaning that invasion itself was not the only thing influencing the markets at this time. In general, these sell-offs are usually driven by investors' uncertainty regarding how severe or prolonged the conflict might be, rather than the true economic fundamentals for the companies that make up the S&P 500 or any other index for that matter. And importantly, markets are forward-looking, and as more information becomes available, the range of possible outcomes narrows, and markets begin to stabilize. We can see this evidence on the left side of this chart as we look at the positive overall growth of markets in the 6 and 12-month periods following most of the events listed here.
Yeah, and to follow up with that point, look at history. This dynamic of market resilience becomes even clearer. Looking back at the last century of market returns through this growth of a $1 chart, we can see that stock markets have shown strong tendencies to recover and move even higher over time through periods of war and even non-geopolitical events like the Great Financial Crisis or even COVID. Notice how in periods following the onset of new conflict, markets tend to finish higher in the 12 months after the event and even higher following that. This might seem counterintuitive, especially when headlines are dominated by uncertainty. And with market history as our guide, albeit imperfect for how any one situation might play out in the future, it shows us that markets are driven by earnings, innovation, economic growth, not just geopolitical events.
And when it comes to geopolitical events and market performance, investors' own behavior can drive their outcome, and it's not always for good. For example, during periods of geopolitical stress or other market shocks, our instincts to do something can be strong, whether that means moving to cash or making other defensive moves. While this can seem reasonable during periods of heightened uncertainty, it often leads to worse long-term outcomes. This chart shows how this sort of dynamic has played out in the US stock market since the year 2000. And let me give you an example. Let's say you're an investor and are uncomfortable staying invested in the stock market given recent headlines, and you desire to do something has you selling your stocks and moving to cash. If you were to have done that at some point during the 25-year period shown on this chart, and were to miss even just the single best week of stock market returns during this period, you would have missed out on approximately 16% of the market's returns. And if you were to sit in cash longer because you were waiting for the right time to get back into the market, missing the best 6 months would have meant missing out on 35% of the market's returns. And this just goes to show us that market recoveries don't come with signals and that they tend to happen quickly and unexpectedly. These periods of recovery are responsible for a significant portion of long-term market returns. And all of this highlights the fundamental relationship of investing. Risk and return are inherently related. And as investors, we should expect periods of uncertainty and associated market sell-offs. And changing your strategy just when risk shows up can often put you in a worse shape than just staying the course.
Exactly. And going forward, it's important to focus on what truly is important, like progress towards your long-term goals, maintaining diversification, and revisiting your risk tolerance. As always, thank you for your time to watch our video today, and we're here to help. Feel free to call with any and every question. Thank you.